Okay, so in today's video, I'll be covering Meta stock and whether or not I think it's a buying opportunity today. So for reference, this is my portfolio. I update this weekly on the channel, so feel free to go and check it out. So in today's video, I'll be covering Meta stock. This stock is down around 12% over the past 5 days after its earnings report. And if you're to look at the earnings report itself, I don't think there was anything wrong apart from this one line, which I will cover later on. So revenue was up 26%, expenses was up 32%, income from operations, operating income was up 18%. So overall, it's a very healthy business that is still growing quite strong fundamentally. And the reason why the stock fell was because of this line over here. So they said, as a result, our current expectation is that CapEx dollar growth will be notably higher in 2026 than in 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth driven primarily by infrastructure cost, including incremental cloud expenses and depreciation. Employee compensation costs will be the second largest contributor to growth, as we recognize a full year of compensation for employees hired throughout 2025, particularly AI talent and add technical talent in priority areas. So the markets clearly don't like what Meta is doing right now. They're spending a lot of money on AI. So besides that, Meta is also financing some of its data center deals through very creative accounting methods. So over here it says Meta set to clinch $30 billion financing deal for data center site. So what they've used over here is something called a special purpose vehicle. Let me elaborate on that one. So essentially what Meta has done over here is that Meta and this other company, which is Blue Owl Capital, will be going into a joint venture whereby Blue Owl Capital owns 80% of the stake and then Meta owns 20% of the stake. So what this does is it writes off all the debt and makes sure that Meta doesn't have any of the debt on the books of the company, and all of the debt will actually be transferred to this other company here, which is Blue Owl Capital. And this also allows Meta to use the data center. And in exchange for that, Meta is offering guarantees to pay up for the value of the data center if they stop operations at that data center site. So this is actually a creative way that Meta is using right now to basically remove debt from its balance sheet. It's still leverage, but some analysts will term it as hidden leverage. So the company is clearly financing a lot of its data center deals, and they're creating all these different interesting methods to try and fund for it. And besides that, they also introduced a new bond yesterday, which was why the stock fell by around 12% on one single day. So for Meta, no one knows what they're spending all this money for. So for example, your Amazon, Microsoft, Google, they're spending money because they have a cloud business that is growing. But for Meta, they don't have something similar to that. The market is disillusioned as to what they're spending all this money for. They don't have a cloud business like your hyperscalers, but they have many levels to pull, almost limitless. So let's talk about Meta as well as some of the levers that it can pull. So in my opinion, I think Meta is a wonderful business. It has many different levers to pull. So imagine next time if Meta directly takes a cut off of the revenue from a store itself that is built around Meta's platform, as well as Shopify. That is one avenue that the company can venture towards. And then besides that, we have WhatsApp monetization that the company is now actively pushing, but it's still at its early growth phase. The paid WhatsApp service is up around 59% year on year from last year. So it's currently now at around $590 million. So overall, I think Meta has a lot of different levers to pull. They're introducing Reels, Threads, all these different new features into their platforms. And for me, Meta is a high quality company for sure. That is fundamentally very strong as well. But the problem is this, Meta is trying to become the next OpenAI. Or at least Mark Zuckerberg is trying to become the next OpenAI, which is why the company is burning so much cash. And in order for them to become this next OpenAI, they need to burn a lot of cash over the next few years. And investors are currently scared. Investors are currently disillusioned. Investors don't know where they're spending all this money for. And what the management has said is that they feel it is important for them to spend this money up front, which I'll cover later on as well. So really for Meta, what they've said over here is that Meta is spending money ahead of time because they are anticipating the best case scenario. And then if the worst case scenario comes, then they'll be using all this existing infrastructure that they have for their existing business anyway. So what Meta is doing over here is they're buying a call option on AI in exchange for some depreciation, which will hurt their bottom line in the future. I think overall it's a move that is not really shareholder friendly, But if Meta can get to a decent enough valuation, I think all these concerns will be offset by the low valuation. So for Meta, if you're to look at the price to earnings ratio, this is normalized. It's currently trading at a 23 times of earnings. It's one of the lowest. In fact, I think it is the lowest in all your different Max 7 companies. And I'm actually waiting for Meta to drop even further on this sentiment news. Hopefully it drops a lot more so that I can possibly look for an entry. I think Meta is a decent business, and if the valuation is able to offset the risk associated with the investments, then it could be a buying opportunity over the next few weeks and months. Next portion, I'll be covering some other companies that are on a dip. So the first two companies that I'll be covering are Mastercard as well as Visa. So these two companies are down after earnings. The earnings were quite decent. So if you have to look at the earnings itself, this is Mastercard's earnings on top, followed by Visa's earnings at the bottom. So for Mastercard's earnings, revenue went up by 17%. Their adjusted net income went up by 10%. Adjusted diluted EPS went up by 13%. So overall, it was almost business as usual for Mastercard. As for Visa, the adjusted EPS went up by around 10% as well. Net revenue went up by 12%. So it's business as usual for all these two companies here. They're forecasting that the consumer will continue to stay strong in 2026, and with some potential stimulus checks coming in from the Trump administration, and with the stock market hitting all-time highs, boosting consumer sentiments, this will probably mean that Visa and Mastercard will see continued consumer strength over the next 1 year, 2 years. And currently, if you have to look at the valuation as well, they're not trading at demanding valuations. So Visa, for example, is trading at a 29 times of earnings. Mastercard is currently trading at a 35 times of earnings. And if you have to zoom out over the past 10 years, this is probably one of the lower ends in terms of their valuations. So for Visa and Mastercard, I think they're quite compelling today. They're trading at decent valuations, which was why I added to these positions. Hopefully they drop even further so that I can continually add to all these payment rails. Next company is ADP. So ADP is down around 7% over the past 5 days, currently trading at a 25 times of earnings. I think for ADP, the problem with the business is simply the fact that AI is innovating, AI is coming up, and when AI comes up, we will see job loss left, right, and center. And ADP, being quite reliant on employment, could see some of its main business being hurt as a result of this. So that's why I don't think ADP is a buy today. I think it's a company that is a compounding machine, fundamentally very, very strong, currently trading at a 25 times of earnings, which is not extremely expensive for a 10% grower, but I will look for better opportunities rather than ADP. Next company is Copart. So Copart is down around 5% in the past month alone, currently down around 25% year to date. So for Copart, it is currently trading at a 26 times of earnings, and overall I would say for Copart, there's still headwinds ahead of it. So I'm actually looking for a lower entry for my next ad into this wonderful company. I think this company is one that will compound continually over the next few years, over the next 5 years, next 10 years, because your total loss frequency will continually go up. That's a secular trend tailwind for the company as your parts become more and more expensive. And for Copart, you have a catalyst event if the company buys back a lot of shares, like what we've seen from MSCI just this quarter. So the company has around 12% of its entire market cap in cash right now. And if they're able to put that cash to work, then we could see a bump up in the EPS in one single quarter, which will be a catalyst for this company. And it's something that we've seen over the past few times that they bought back a lot of shares as well. So this is a catalyst event that could come up. Besides that, they have the international growth story as well. So they're currently quite dominant in Europe. So for example, in UK, they have around 50% of the market share there. So if they're able to continually expand that portion through acquisitions, then this could be a wonderful story that could play out. I don't expect this company to be able to give me 20% returns. 15% returns is possible for this company if we see some form of a multiple expansion. But realistically, it will be between around a 10 to a 12% return from this compounding machine. I hope you guys have found this video useful and invest.